Something just happened in the silver market that almost nobody is talking about correctly. Silver touched levels it hasn't seen in decades, and then, within hours, it fell. Hard. And the headlines immediately rushed in with their ready-made explanations. Profit-taking, risk-off sentiment, CPI surprise. Neat, clean, packaged, delivered to your feed before the dust even settled. But here's what they didn't tell you. The move down wasn't what broke. It was what was revealed. And if you understand what was actually happening beneath that price action, beneath the charts, beneath the CPI number, beneath the talking head narratives, you're going to see the silver market in a completely different way. Not as a commodity, not as a metal, as a mirror. A mirror reflecting something far deeper inside the global financial system than most retail investors ever get close to. So take a breath, because we're going to go through this carefully, layer by layer. And by the end, you're going to understand something that institutional desks understand, that macro strategists whisper about in research notes, and that the consumer-facing financial media almost never explains with the depth it deserves. Let's start where this story actually starts, not with silver, with a number, the Consumer Price Index, CPI, 3 letters that move markets, shake policy decisions, and apparently, according to the dominant narrative, just caused silver to crash from its multi-decade highs. The CPI print came in, the headline screamed, "Inflation cooling," and the algorithms did what algorithms do. They sold. Silver dropped. Case closed, right? Not even close. Here's the first thing you need to understand about CPI. It is not inflation. It is a measurement of inflation. And the difference between those two things is everything. CPI is a survey. It's a basket of goods, weighted by methodology, that has been revised, adjusted, and restructured multiple times over the past 5 decades. The way we measure housing costs in CPI today, through something called owner's equivalent rent, is categorically different from how we measured it in the 1970s. The way we handle technological improvements through hedonic quality adjustments means that if your laptop gets faster, CPI treats that as a price decrease, even if you paid the same price. These are not conspiracy theories. These are documented methodological choices made by the Bureau of Labor Statistics, and they are publicly available. Why does this matter for silver? Because the entire justification for the silver sell-off rests on the assumption that a lower CPI number means real inflation is actually declining. And if inflation is declining, the argument goes, then precious metals, which are supposed to be inflation hedges, should decline too. That's the logic. That's the trap. And it is a trap. Here's what the CPI number cannot tell you. It cannot tell you what is happening to money supply. It cannot tell you what is happening to the purchasing power of savings held in government bonds. It cannot tell you what is happening to the real cost of shelter for the median American household when you factor in mortgage rates, property insurance increases, and property tax reassessments. It cannot tell you what sovereign wealth funds in Asia and the Middle East think about the long-term credibility of dollar-denominated reserves. And it absolutely cannot tell you why central banks around the world have been buying gold, and by extension, pressuring silver's monetary premium at the fastest pace in recorded modern history. The CPI number tells you what happened to a weighted basket of consumer goods over a trailing period. That's it. And the market's decision to treat that number as the primary explanatory variable for a silver crash from generational highs tells you something not about silver, but about how short the market's attention span truly is. Now let's talk about the price level itself, because this is where the psychological trap deepens. Silver at $86, or anywhere near that level, is not just a number on a chart. It is a statement. A statement being made by some combination of institutional money, macro funds, commodity traders, industrial procurement hedgers, and yes, retail investors, about what silver is worth right now relative to everything else in the world. And when that statement gets made at a generational price level, the question you should always be asking isn't, why did it go up? The question is, why did it take this long? Let me put this in context. Silver's previous all-time high was set in 1980, 45 years ago. During the Hunt Brothers episode, a moment of deliberate market corner attempt, silver touched $50 per ounce in nominal terms. In 2011, silver ran to approximately $49. It touched that level again, and then it collapsed back into a multi-year bear market that took it all the way down below $12 in 2020. 45 years of history, and silver had not convincingly broken above its 1980 nominal high until very recently. Think about what that means in real terms. Adjusted for even the government's own CPI figures, the real price of silver was, for most of the past decade, significantly below its 1980 peak. In a world where the money supply of the United States has expanded by trillions of dollars, where global debt has compounded at extraordinary rates, where central banks have run zero interest rate policy for over a decade, the commodity that is supposed to reflect monetary debasement was still, in real terms, cheaper than it was during the Carter administration. That's not a natural market outcome. That requires explanation. And part of that explanation lives in something that silver market analysts have been discussing for years, but that mainstream financial media treats as a fringe concern: the paper silver market. The COMEX, the Commodities Exchange in New York, is the primary pricing mechanism for silver in the Western financial system. And the ratio of paper silver contracts to actual physical silver available for delivery has historically been extraordinarily high. We're not talking about a market where every contract represents a deliverable bar sitting in a vault. We're talking about a market where the price is set by leveraged futures trading, where the vast majority of contracts are settled in cash rather than physical delivery, and where the relationship between the paper price and the actual cost of physical silver in the real economy can diverge meaningfully during periods of stress. This is not conspiracy. This is market structure, and it has real consequences for how we interpret price movements, including crashes from high levels. When silver ran to extreme highs and then pulled back sharply on a CPI print, there are two possible dominant explanations. The first is the mainstream explanation. Inflation expectations fell, the dollar strengthened, and precious metals sold off accordingly because their primary use case as an inflation hedge became less compelling. Clean, simple, wrong in its completeness. The second explanation, which is the one that institutional traders understand, is more layered. Leveraged long positions built up during a rapid price ascent reach a point of fragility. A catalyst, any catalyst, can trigger stop-loss cascades. The CPI number was the catalyst, but the move was amplified by the mechanical unwinding of leveraged futures positions, not by a fundamental reassessment of silver's monetary value or its industrial demand outlook. The CPI number didn't change the supply of silver in the ground. It didn't change the demand for silver in solar panels, electric vehicles, medical devices, or defense electronics. It didn't change the trajectory of central bank gold purchases. It triggered a technical unwind, and the financial media reported the trigger as if it were the cause. Now we need to talk about what is actually driving silver at the deepest structural level, because this is where the story gets genuinely important. Silver exists at an extraordinary intersection. It is the only asset on Earth that simultaneously functions as a monetary metal, with thousands of years of history as a store of value and medium of exchange, and as a critical industrial commodity in the technologies that are supposed to define the 21st century. This dual nature is not a minor detail. It is the most important structural feature of the silver market, and it is profoundly underappreciated by generalist investors. Let's take the monetary side first. Gold is the Tier 1 monetary metal. Central banks hold it. The BIS classifies it as a Tier 1 asset, and over the past several years, central bank gold buying has been running at levels not seen since the post-Bretton Woods era. This is documented. The World Gold Council publishes these figures quarterly. What you need to understand is what is driving it. The countries doing the most aggressive buying are not in the Western sphere. China, India, Poland, Turkey, multiple Middle Eastern sovereign wealth funds. These are the buyers that have been accumulating physical gold at pace. And the implicit message behind that accumulation is not subtle to anyone who studies reserve management. These institutions are, at the margin, reducing their exposure to dollar-denominated assets and increasing their exposure to assets that sit outside the dollar clearing system. They are doing this methodically, strategically, and at scale. Gold's move to all-time highs, which preceded silver's move, was not primarily about American retail investors buying gold ETFs because they were worried about grocery prices. It was about sovereign-level repositioning in response to a geopolitical and monetary architecture that is slowly, unevenly, but genuinely shifting. And silver follows gold. Not always immediately, not always perfectly, but over meaningful time horizons, the gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, tends to compress when precious metals are in a genuine bull phase. When gold leads and silver follows with higher percentage moves, that is historically how precious metals bull markets have resolved. The silver move to high levels was, in this framework, not irrational exuberance. It was delayed recognition. Now the industrial side. And this is where the story becomes genuinely long-term structural, in a way that has nothing to do with CPI. Silver is the most electrically conductive metal on the periodic table. And the green energy transition, whatever your political views on its pace, its management, or its costs, is a silver consumption event of historic proportions. Every solar panel requires silver. The photovoltaic cells that convert sunlight into electricity use silver paste as their conductive layer. And as solar panel efficiency has improved, the amount of silver per panel has actually increased for the highest performance models. The Silver Institute, which tracks industrial demand, has documented rising solar demand for silver over consecutive years. This is not projection, this is measured consumption. Electric vehicles add another demand vector. Modern EVs use silver in their electrical contacts, charging systems, and increasingly in their battery management systems. As the global vehicle fleet electrifies, even at a pace slower than government mandates might suggest, each marginal EV sold represents incremental silver demand that didn't exist in a combustion vehicle. Then there's defense. Modern weapons systems, guided munitions, electronic warfare equipment, advanced radar, drone technology are silver-intensive. Defense procurement has been rising across NATO countries, across Asia, and is not showing any signs of reversal given the current geopolitical environment. And medical applications. Silver's antimicrobial properties have made it a growing component of wound care products, surgical instruments, and increasingly, next-generation medical devices. This demand is quiet, consistent, and growing with global healthcare spending. Now here is the supply side of this equation, and this is where it becomes genuinely alarming if you study it carefully. Silver is primarily mined as a byproduct. Approximately 70 to 75% of global silver production comes not from dedicated silver mines, but as a secondary product from copper, lead, zinc, and gold mining operations. This means that silver supply is largely inelastic with respect to silver prices. When silver prices rise, you cannot simply open more silver mines to respond, because most silver doesn't come from silver mines. Supply responds to the economics of the primary metal being mined, not to the price of the byproduct. Primary silver mines are relatively rare. Mexico, Peru, China, Russia, and Chile are major producers. The geological reality is that high-grade silver deposits are not common, and the pipeline of new primary silver projects, from discovery through permitting through development to production, takes a decade or more, even in a supportive permitting environment. In most Western jurisdictions, the permitting environment is not supportive. This creates a structural supply constraint that is independent of price signals. Rising silver prices don't quickly bring new supply online the way they might in a market where production is more elastic, and that constraint sits directly against an industrial demand curve that is growing in multiple directions simultaneously. The above-ground silver inventory situation is also worth understanding. Gold has enormous above-ground stocks. Virtually all the gold ever mined is still with us in some form, held in vaults, in jewelry, in central bank reserves, in ETFs. This stock-to-flow ratio is one of gold's defining monetary characteristics. Silver is different. Most of the silver ever mined has been consumed, industrially used, gone. The silver that went into film photography, into mirrors, into early electronics, most of it was not recovered. It was lost at concentrations too low to economically recycle. Above-ground silver inventories are a fraction of what you might expect given historical production. And that changes the supply dynamics in ways that are not always well understood by people who think of silver primarily as a monetary metal. So when you put all of this together, the monetary repositioning happening at the sovereign level, the structural industrial demand from clean energy and defense and medicine, the inelastic supply constrained by mining economics and geology, the depleted above-ground inventories, and the paper market pricing mechanism that can suppress price signals even when physical demand is strong, what you have is not a simple commodity. What you have is one of the most complex supply-demand stories in any market anywhere in the world. And then a CPI number comes in slightly below expectations, the algorithms trigger a cascade, and the financial media tells you silver crashed because inflation is cooling. Do you see the trap now? Let's talk about the gold-to-silver ratio in more detail, because this metric is one of the most important and most overlooked tools for understanding where we are in the precious metals cycle. Historically, the gold-to-silver ratio has averaged somewhere in the range of 40 to 60 over the modern era. In geological terms, meaning the ratio in which gold and silver exist in the Earth's crust, the ratio is approximately 1 to 17. For most of human monetary history, the bimetallic ratio used by governments was in the range of 15 to 1 to 16 to 1. The United States officially fixed the ratio at 15-1 when it established its bimetallic standard. During periods of financial stress and precious metals distrust, like the 2020 pandemic crash, the gold-to-silver ratio exploded to over 120. 120 ounces of silver to buy 1 ounce of gold. That was an extreme reading in either direction. It was the market saying that silver's industrial demand was crushed, that monetary panic favored gold, and that silver was orphaned between its two identities. From that extreme, the ratio has been compressing. And when silver ran to its recent highs, while gold was also elevated, the ratio was tightening toward levels that are still historically elevated relative to the geological and historical monetary precedents. This means that even at $86 silver, which sounds dramatic, if gold was simultaneously trading at proportionally higher levels, silver was not necessarily overvalued relative to gold by historical standards. The ratio compression trade, which is what sophisticated macro funds are often playing when they buy silver in a precious metals bull market, is not a bet on CPI going higher. It is a bet on the monetary architecture. It is a bet that the anomalous, extreme ratio readings of the past decade, driven by paper market dynamics and industrial demand suppression during economic slowdowns, will normalize towards something that reflects both the monetary and industrial realities of the metal. A CPI print doesn't change that thesis. A CPI print is noise inside a much larger signal. Now let's address the psychology of what you just watched happen, because this matters too. When an asset makes a dramatic move to generational highs and then experiences a sharp pullback, the human brain does something predictable. It anchors to the high. It experiences the pullback as loss, even if the price is still dramatically higher than it was a year or two ago. The financial media amplifies this by using language like crash and collapse, words that trigger fear responses and drive engagement. And the fear response does two things. It shakes out weak hands who bought near the top with emotional rather than analytical conviction. And it prevents new participants from entering because the word crash has been attached to the asset in their recent memory. This is not accidental. It is the mechanical reality of how markets transfer wealth from the impatient to the patient, from the emotionally reactive to the structurally informed. The investors who understand why silver moved, not the CPI story, but the actual structural story, are not looking at a sharp pullback from a high as a crash. They are looking at it as a retest, a consolidation within a larger thesis that plays out over years, not days. They are asking different questions, not why did silver fall, but did anything change in the supply-demand structure? Did central banks stop buying gold? Did solar demand suddenly disappear? Did above-ground silver inventories suddenly replenish? Did the geopolitical pressures driving sovereign reserve diversification reverse? And the honest answer to all of those questions is no. Nothing structural changed. A futures market had a leveraged technical unwind triggered by a scheduled data release. That's the whole story of the crash, if you insist on calling it that. But let's be careful here, because intellectual honesty requires acknowledging the genuine risks and uncertainties in the silver thesis. This is not a one-way story with no counter-arguments. The first genuine risk is the industrial demand side. If the global economy enters a significant recession, a real contraction, not a soft landing, industrial silver demand will fall. Solar installations slow when financing becomes expensive. EV sales disappoint when consumer credit tightens. Defense procurement remains relatively stable, but it won't offset a broad industrial contraction. Silver has historically underperformed gold during deflationary recessions, precisely because its industrial identity becomes more important than its monetary identity in the market's pricing. The second risk is positioning. When a market makes a dramatic move to multi-decade highs in a relatively short time, speculative positioning becomes crowded. Crowded trades unwind violently when sentiment shifts. The question is always whether the fundamental buyers, the industrial users, the sovereign-level accumulators, the long-duration macro funds, are strong enough hands to absorb the selling of the weak speculative hands during the unwind. This is not always predictable, and history is full of examples where fundamental stories were correct, but timing was punishingly wrong. The third risk is the dollar. Silver is priced in dollars globally. A significant dollar strengthening cycle, driven by interest rate differentials, capital flows back to the United States, or some other factor, creates a headwind for dollar-priced commodities, even when local currency prices are rising elsewhere. The interplay between the dollar index and precious metals is real and significant, even if it isn't the only factor in the equation. The fourth risk is technological substitution. While silver's properties make it uniquely suited for its current industrial applications, material science is constantly evolving. If a viable substitute for silver in photovoltaic cells were developed and commercialized, it would change the industrial demand story significantly. This risk is real, but probably long dated. The research to commercialization pipeline for these kinds of materials is measured in decades, not years. But intellectually, it belongs in the risk register. And the fifth risk is the most philosophical one, the monetary thesis itself. The argument that central banks are diversifying away from dollar-dominated reserves, that the global monetary architecture is slowly shifting, that gold and silver benefit from this structural change. This is a long-duration thesis with enormous uncertainty about timing, pace, and magnitude. It could take much longer to play out than any investor's patience can accommodate. And policy responses from major central banks or governments could alter the dynamics in ways that are genuinely unpredictable. The world is complex, monetary systems are resilient, and markets have a way of humbling certainty. None of this invalidates the structural story, but anyone who presents you with silver as a guaranteed outcome, with a timeline and a specific price target, is selling you something. The honest version of the silver thesis is a probabilistic argument about structural forces that are real and measurable, playing out over a time horizon that is uncertain, against genuine macro risks that deserve respect. The job of an informed investor, or even just an informed observer, is not to pick a number and call a target. It is to understand the forces at work, to distinguish between signal and noise, and to think clearly when the media is flooding the zone with oversimplified narratives designed for engagement rather than understanding. And the CPI trap, the idea that a single backward-looking government measurement of consumer prices explains a complex, multi-factor move in a commodity with a 1,000-year monetary history and a 21st century industrial identity, is exactly the kind of noise that obscures the signal. Let's bring this back to where we started. Silver pulled back sharply from multi-decade highs. The reason given was a CPI print. The real reason, to the extent that any single sentence can capture it, is that leveraged futures positions in a paper market were unwound by a mechanical catalyst in a market structure where the paper price can, for periods of time, diverge meaningfully from the underlying physical reality. The structural story didn't change. The monetary repositioning happening at the sovereign level is ongoing. The industrial demand from clean energy, defense, and medicine is structural and growing. The supply is constrained by geology and mining economics in ways that don't respond quickly to price signals. The above-ground inventory position is thinner than most people realize. And the paper market pricing mechanism that has historically suppressed silver's price relative to its fundamental value is under more scrutiny, from regulators, from physical market participants, and from the growing class of investors who understand the distinction between a paper claim on silver and an actual silver bar. None of that changed because of a CPI number. So the next time you see a headline that says silver crashed because of inflation data, or because of Fed commentary, or because of dollar strength, or because of risk-off sentiment, do what the institutional investors do. Ask the second question. Ask what the data actually says versus what it's being said to mean. Ask whether anything structurally changed, or whether the paper market just had a bad afternoon. Ask who benefits from the narrative being framed as a crash versus a consolidation. Because the language we use to describe markets shapes the decisions we make about them. And the financial media's incentive, more engagement, more clicks, more emotional reaction, is not perfectly aligned with your incentive, which is to understand what is actually happening. Silver is not simple. It never has been. It sits at the intersection of monetary history, industrial modernity, geopolitical realignment, and market microstructure. Understanding it requires holding multiple frameworks in your head simultaneously. It requires intellectual patience and resistance to oversimplification. But for those willing to do that work, the real story of silver is not that it crashed from $86. The real story is why it was there in the first place, and that story is still being written,